Major financial crashes aren't random, chaotic events. They are the predictable end of a mechanical sequence driven by human psychology and market structure. A handful of savvy investors have repeatedly recognized this pattern and used the same core three trade strategy not just to protect their wealth, but to profit immensely. From the fallout, this playbook has been used with remarkable success across nearly a century of market cycles. Today, we're breaking down this powerful strategy as it was executed in 1929, 1987, and 2008, and we'll look at the compelling evidence that these same three trades are being set up right now for a potential downturn around 2025. So, what is this three trade strategy? It is designed to handle three distinct phases of a market cycle as it goes from a speculative bubble to a full-blown crash. Trade 1 is the recognition phase, and it's all about capital preservation. The goal here is simple: protect yourself from the initial losses. The action is to convert your stock positions into cash. This is the smart money exit, securing your capital before the real decline even begins. Trade 2 is the wealth preservation phase, a defense against inflation. The purpose is to protect that cash you just raised from the inevitable currency devaluation that happens after a crisis. The action: accumulate gold or other hard assets as governments print money like there's no tomorrow to stabilize the system. Gold preserves your purchasing power. Trade 3 is the profit phase. This is where you go on offense. The goal is to actively profit from the market collapse itself. The action is to buy volatility instruments, things like shorts, put options, or credit default swaps. These are instruments designed to literally explode in value as prices fall violently. Let's travel back in time to see this in action. First stop, the 1929 Great Crash. The Roaring Twenties were a time of wild euphoria, fueled by record high margin debt. People were borrowing up to 90% of a stock's value, creating an incredibly fragile, over-leveraged system. Now for Trade 1, a man named Joseph Kennedy saw that a system built on this much leverage had zero room for error. Months before the market peaked in September 1929, he quietly and systematically sold his vast stock holdings and converted them into cash. When the crash hit in October, Kennedy was safe and sound, while his over-leveraged friends were completely wiped out. For Trade 2, we look at Bernard Baruch. He secured his wealth in physical gold. He knew a crash of this magnitude would force the government to manipulate its currency. His foresight paid off big time in 1934 when President Roosevelt revalued gold, handing gold holders an instant 69% gain in dollar terms. And finally, Trade 3. With his capital safe, Joseph Kennedy went on the attack. He started shorting stocks. This means he borrowed shares, sold them at their high prices, and then bought them back after they had completely collapsed. The result? He pocketed an estimated $15 to $50 million, a truly astronomical sum for that era. Now, let's fast forward to 1987, Black Monday. The mid-80s saw high valuations and a new destabilizing force: automated program trading. One hedge fund manager, Paul Tudor Jones, executed the playbook perfectly. By mid-1987, he was worried about valuations and started Trade 1. He methodically reduced his long positions and raised cash. For Trade 2, he held gold as a defensive play. When the panic hit on Black Monday, gold spiked 58% as investors scrambled for safety. And for Trade 3, he used a more modern weapon: put options on stock index futures. This was his fire insurance. The outcome was stunning. On Black Monday, the Dow fell an unbelievable 22.6% in a single day. But Jones's put options exploded in value, earning his fund an estimated $100 million in that one day alone. Next up, the 2008 global financial crisis. This crisis was rooted in the subprime housing bubble and required even more specialized weapons. Trade 1 was already in motion years before. Investors like Michael Burry and John Paulson were actively raising cash as early as 2005 and 2006. Even Warren Buffett, the ultimate patient investor, simply let his cash pile grow to over $60 billion by 2007, famously saying he couldn't find anything attractively priced. For Trade 2, John Paulson correctly predicted that the Federal Reserve would respond with unprecedented money printing, what we now know as quantitative easing. As the Fed's balance sheet ballooned, gold surged from around $600 an ounce to over $1,900 by 2011, making Paulson billions more. And for Trade 3, the weapon of choice was the credit default swap, or CDS. Burry and Paulson bought insurance policies on mortgage bonds from the very banks that swore those bonds were rock solid. When the bonds inevitably defaulted, the CDS contracts paid out massively. Paulson's funds alone collected a staggering $15 billion. So, where are we now? Is this pattern repeating for a potential 2025 crash? The evidence is compelling. Trade 1 is already in progress. Warren Buffett's Berkshire Hathaway is sitting on a record $189 billion cash war chest. At the same time, corporate insiders like Jeff Bezos and Jamie Dimon are selling their own company's stock at a historic pace. This kind of systematic exit is exactly what we saw in the 12 to 18 months before every previous major crash. Trade 2 is also happening right now. From 2022 to 2024, central banks around the world have bought over 3,000 tons of gold. That's the highest three-year total on record. They are actively trying to get away from relying on the US dollar, and Trade 3 is underway as well. Sophisticated investors are placing bets using credit default swaps, but this time on commercial mortgages. They're also buying put options on major market indexes. The cost to insure against commercial real estate defaults has already spiked by 300 to 500%. The first three trades are the setup, but there's an implicit fourth trade, the real reason for the whole strategy, to acquire generational assets at a fire sale price after you've preserved your capital with Trade 1, protected its purchasing power with Trade 2, and generated massive profits with Trade 3. The final step is to deploy that capital at the point of maximum fear and pessimism. This is the checkmate move. It is Warren Buffett investing $5 billion in Goldman Sachs at the bottom in 2008. It is Bill Ackman using his crash profits to buy up stocks at deeply depressed prices in March 2020. So how can an everyday investor use this grand strategy? It can be simplified. First, Trade 1, raise cash. Consider reducing your stock allocation and holding that cash or putting it in short-term treasury bills. This gives you dry powder to use later. Second, Trade to buy gold. You could allocate a small portion of your portfolio, say 5 to 10%, to a gold ETF. Think of it as insurance to preserve your purchasing power against future money printing. And third, Trade 3, buy protection. This is more advanced, but you could consider buying put options on a broad market index ETF like the SPY. This is portfolio insurance. It's a small premium you might lose if nothing happens, but it could return many times your cost in a major downturn. This pattern has repeated for nearly a century. The trades are the same, the sequence is the same. Position yourself while you still can. The hardest part is having the courage to act when fear is at its absolute maximum. So start preparing your shopping list now. Thanks for watching. If you found this valuable, don't forget to like and subscribe for more content.